When you invest in shares, you unlock two types of incomes. The first one is the capital gains, and the second one is dividends income. Let's look at the capital gains. Capital gains arise when you buy shares at a low price, hold them for a period of time for the price to go up, and offload those shares or sell the shares once the price has gone up. The difference or that profit that you have made, we refer to it as a capital gain. That type of income is taxed at the withholding tax rate of 15%, which is final tax. The second form of income, that's dividend income. Dividend is a share of the profits of the company distributed to all shareholders based on the number of shares that you hold. Therefore, dividends only arise when the company performs well. And out of the dividend policy of that particular company, the directors recommend an amount to be distributed to the shareholders as part of the profit in that return. The dividend income will be taxed at a withholding rate of 5%, which is also final tax. What do we mean when we say a tax is a final tax? One, a withholding tax is that tax that is deducted at the source of that income, where the payer of the income is legally becomes a tax agent of the tax authority. And in this case, it means for it to be a final tax, it means that the receiver of that income, who is you, the investor, you will not be required to account for that income when you are accounting for your taxes. We account for taxes by filing tax returns. Therefore, it means any income that has been taxed as a final tax, that one you will not include in your tax return. Further to that, for you to be able to purchase shares through the Nairobi Stock Exchange, there are several things that you need to have. And that is what we shall be looking at after 3 seconds break. Welcome back. For you to buy your shares, you must pay a visit to the capital markets. To jog your mind, we earlier discussed about the financial markets, and we divided that market into three. We had number one, the money market, which is a segment of the financial market that deals with short-term securities. Then we had the forex markets that deal with the exchange or buying and selling of currencies. Lastly, we had the capital markets, which is a segment of the financial market that deals with buying and selling of long-term securities, that is the bonds and shares. Now, for you to be able to participate in the capital markets, there are two conditions that you must meet. Condition number one, you must have a broker. You must have an intermediary. And number two, you must be able, or you must purchase a minimum batch of 100 units or 100 shares of the particular company that you are interested in investing in. Further to that, you will be required to meet the following requirements. One, you need to have a CDS account. Note that this account is different from the CSD account that you opened on the CSD or the DAO platform that enabled you to trade with the central bank. That was a primary market. Immediately the auction closes and the payments are done, those instruments or the bonds are offloaded to the secondary market, which is the capital market. In this case, for Kenya, we are talking of the Nairobi Stock Exchange. That is where now we are buying our shares. So the Central Depository System account, or the CDS account that you are required to operate in a purchase of your shares in the capital market is different from the CSD account. On top of that account, and now that you have already elected or selected your preferred broker who must be validly registered with the market and the Capital Markets Authority, 3, you'll be required to have your capital. Capital will be the amount that you would want to invest or the amount that you want to spend in purchasing the company that you are wishing to. I would wish to reiterate at that point, it's not just we are buying shares. Rather, we are buying companies. Buying shares is on a mindset that will not give you purposely what you're looking for as an investor. In other words, you are buying a company. A company is divided into small bits, the ones that we are calling shares. So the amount of shares that you buy, the value is equivalent to a portion of that company that you will have bought. So it's far much better for as an investor to look at it as a purchase of a company. Number 4, you require to meet the brokerage fees. These middlemen, the brokers, do not offer pro bono services. And as we discussed earlier on, in finance, there are no free lunches. Those transactions, when your instructions are effected by your broker, the broker will charge you a fee which is set at a maximum of 2% of the capital that you're investing. Once you have met all those requirements, then you should have an idea of the company that you are investing in, the company that you are buying. In other words, you should be able to select the stock that you want to buy or the company that you want to purchase. And how do you go about that one? The very important part is you need to have an understanding. You need to understand that company and the industry in which it is. Number 2, you need to understand its business model. You also, thirdly, need to compare it. Compare it with peers. That company is in an industry where there are other players. Compare the company of your choice with the other players in the same industry. Compare it with the peers. Also, you need to go through the financial reports. You need to go through the financial reports, that is the income statement. In that case, you are going to compare financial reports covering several years. As a practice professionally, those reports are prepared with comparable data. At least they will give you data for the current and the immediate previous year. So if you're looking at reports of 2 periods, at least you will have covered a history of 3 years. You will need to gather the profitability of that business. Is it increasing or is it declining? You need to look at the cash flow statements. Have an understanding of the major cash inflow or cash sources of that business. And as a normal, a business should generate most of its cash or cash inflows from its operating activities. So it should be, you should have that understanding that if you are finding major cash flows from disposal of assets, it should raise questions whether there are branches that are closing down or the company is downsizing, or what could be the reason behind that. Then we'll look at the issues. If we have other cash flows that are coming from financing activities, do they account for loans that have been obtained, or is it a fresh equity that has been sourced? Then thirdly, we will need to look at the financial position statement of that particular company, which in most cases we'll talk about it will give you at least the net worth of that business. You are buying into the net worth or the balance of assets after the liabilities that which belong to third parties. That said and done, there are some skills or there are some things that will be very salient for you as an investor. And the first one will be diversification. You don't put all your eggs in one basket. You need to strike a balance. That speaks to risk spread or diversifying your assets in such a way that in the events that market dynamics hit, the industry, the sector, or perhaps the business, the company that you have invested into, it doesn't affect the others. You don't put all your eggs into one basket or invest in one company in such a way that in the event that company faces difficulties, all your investments, all the entire portfolio is affected. So that is to say, diversify in a sense of markets. You have already invested in the bond market. Now you are in the equity market. Diversify with respect to the companies and sectors. Don't put all your money or your investment in one sector, because when the government is implementing its fiscal policy, these policies target sectors. So if you have placed all your investment, equity investment, in companies within the same sector, that entire portfolio will be affected. So you need to look at one or two or three sectors where you have interests and spread your investment in equities in those sectors. But there is danger of over diversification. Do not spread too much such that individual investments make little financial sense. And lastly, but not least, we'll need to be patient. Patience is a skill. Patience is the most important asset that you will have when you are investing in the equity market. Once you have chosen to get into the equity market for investment, you will hold your securities for some time. And for that reason, there are several factors, there are several measures that you must take into place before you engage in equity investment or long-term investment, as we shall be seeing in the next video. Thank you for watching.